Welcome back. Today, we're diving straight into a comprehensive guide to the digital money landscape of 2026. Look, the crypto frontier is always shifting, right? It gets super noisy out there. So, we're going to use our source material to build a really clear map of the whole ecosystem together. By the end of this explainer, you're going to have a rock-solid grasp on what these digital territories actually are, how they function under the hood, and honestly, why they matter so much to the broader global economy. Let's get into it. Okay, let's dive right into this map. We've got four main stops on our journey today. First up, we'll touch on blockchain and cryptocurrency basics. Second, we'll look at the main types of digital assets. Third, we'll check out the most popular cryptocurrencies out there. And fourth, we'll wrap up with how to actually choose the right asset for you. All right, part one, blockchain and cryptocurrency basics. To really grasp this whole taxonomy, we've got to start with the foundation, the blockchain. So instead of locking your data away in some traditional bank vault, this information is secured in a decentralized, totally unchangeable chain of blocks. Now, the huge takeaway from our source material here isn't just the fancy encryption, it's the fact that this literally cuts out the middleman entirely. And since it's built on open source code, pretty much anyone with the right tech skills can just roll up and build entirely new financial ecosystems right on top of it. Moving on to part two, the main types of digital assets. So this brings us to something that trips a lot of people up, altcoins versus tokens. Basically, altcoins, which are just any alternative to Bitcoin, run on their very own independent blockchains. Tokens? They don't. They're actually issued on top of platforms that already exist. Think of it like this. Creating an altcoin is kind of like buying a completely empty plot of land and building a house entirely from scratch. But creating a token is more like renting an apartment in this massive skyscraper that someone else already built, like Ethereum. It's way faster to get set up for sure, but you're playing by the building's rules and using their infrastructure. Next up in the taxonomy, we've got stablecoins. Now, we all know the crypto market is famous for some pretty wild, unpredictable price swings, right? Well, stablecoins were engineered to solve exactly that problem. Their value is intentionally pegged to a real-world asset. Usually, that's a fiat currency, like the US dollar, but it can even be a commodity like gold. Because they hold that peg, they essentially give you digital fiat stability. This makes them absolutely perfect for everyday calculations, sending payments, or just securely parking your value without waking up in a cold sweat because your portfolio dropped 20% overnight. And then we have NFTs, or non-fungible tokens. Look, standard coins are completely interchangeable. My Bitcoin works exactly the same as your Bitcoin. But NFTs, they are an entirely unique territory. They serve as unchangeable, immutable proof of ownership for a one-of-a-kind object directly on the blockchain. Sure, they got super famous for those digital art monkeys, but at its core, this tech is just a foolproof way to verify absolute ownership of a unique digital or sometimes even physical asset. Our source material actually gives us this fantastic cheat sheet that sums all this up perfectly. You've got coins, which are basically your means of payment inside their own native network. Think Bitcoin. Then you have tokens, which give you a specific utility or access to a service within a project, like Uni. Stablecoins, like USDC, bring that digital fiat stability we just talked about. And finally, NFTs, which lock down that unique ownership. As you can see, every single one of these asset types handles a totally different economic job in the bigger ecosystem. All right, let's jump to part three, popular cryptocurrencies on the market. Now, we absolutely have to start with the pioneer here. Bitcoin is so often called digital gold, right? A safe haven asset when the economy gets rocky. But why is that? Well, it literally all comes down to one number, 21 million. The total supply of Bitcoin is mathematically hard capped. There will never, ever be more than 21 million coins in existence, period. And it's exactly this engineered scarcity that acts as the core engine driving its value as a long-term store of wealth. Next on the map is Ethereum. So if Bitcoin is digital gold, you can think of Ethereum like a massive, totally decentralized global computer. It was built specifically to handle smart contracts and decentralized apps, or dApps. Because it makes it incredibly easy for developers to build on top of it, Ethereum has become the base layer for the vast majority of tokens out there, not to mention the entire decentralized finance, or DeFi ecosystem. It honestly just completely blew the doors off what we thought blockchain tech could actually do. Moving right along, let's look at BNB, or Binance Coin. This right here is your textbook example of a utility token. Remember that apartment building analogy from earlier? Well, BNB basically lives and breathes inside the massive Binance ecosystem. It was created to do very specific jobs, like giving you a discount on trading fees or letting you into exclusive launchpad events. So its value is directly tied to how incredibly useful it is inside that specific closed environment. Okay, so how does all this build a more connected future? Enter our last specific example, Polkadot. Think back to all those independent altcoin houses we mentioned. For the longest time, they were essentially stranded. They couldn't talk to each other at all. Polkadot acts as this vital bridge connecting those separate territories. It's a platform focused entirely on cross-chain interaction, letting data and assets move securely back and forth. It really is the essential infrastructure if we want a truly interconnected web of blockchains. Which brings us to part 4, how to actually choose the right asset. Look, participating in this space consciously means you need a game plan. Step 1, figure out your ultimate goal. Are you looking to hold on to something for the next decade, or do you just want a way to make fast, everyday payments? Step 2, take a look at the asset types we just mapped out and find the one that matches that goal. Step 3, take a really honest look at the risks and the volatility tied to that specific tech. And finally, step 4, pick the asset that actually aligns with your own personal strategy and your comfort level with risk. Before we wrap up this explainer, we definitely need to acknowledge the landscape that's forming right around us. Our source highlights 3 major trends that are defining the reality of digital assets in 2026. First, there's the massive ongoing expansion of DeFi and NFTs, which is just continually broadening how we use all this tech. Second is the rise of cross-chain solutions, exactly like Polygon, finally hooking up all these isolated networks into one big unified ecosystem. And third, we're seeing the imminent rollout of CBDCs, or central bank digital currencies. Now, no matter where you stand on traditional banks, the integration of these government-backed digital currencies is just a fact. It's becoming a huge part of the new regulatory and legal reality for the entire digital asset space. Wow, we have covered some incredible ground today. Getting a handle on these distinct categories is absolutely step 1 if you want to successfully navigate this frontier. But, a map is only useful if you actually know where you're trying to go. So I'm going to leave you with this thought. Based on the map we just built here today, which digital territory aligns best with your own personal financial strategy in this wildly evolving ecosystem? Thank you so much for joining me on this explainer. Keep learning, stay curious, and I'll see you next time.